Strategy at ICICI Securities. Hi Vinod, a very good afternoon and thank you so much for our time. Seems like not a great afternoon coming in for the markets. Vinod, this market fall, what's your take on this one? Because this is definitely getting on the nerves. Firstly, it went on to the nerves of the traders, reaching the key support levels, and now the investors are a little concerned about the fall. What's your take on the fall that we are witnessing? Is it something that you believe is a healthy correction, or you believe that markets, there's something that has really changed in the markets right now in terms of the narrative?
Yeah, thank you. See, fundamentally, I think the key reason why this is happening is since September of last year, if you see, the US bond yield was around 3.6%. Currently, if you see, it's around 4.8%. So that's more than 100 basis point of increase. And fundamentally, we know that when bond yields spike, equity valuations contract. And that's exactly what has happened. In last year, around that point, we were at 23 times on the Nifty. We are now a little below 20x, I guess. So it's more of a reaction to this fundamental angle where the US bond yields are rising significantly. So that's more of it. Apart from that, there have been some risks to growth. We have seen some growth deceleration in the economy, but we believe that that's more to do with this one-off effects of elections and rains and all, which I think there will be some deferral of demand to the second half of this year. But the key concern is this whole bond yield rise and the Trump euphoria that we have seen impacting markets.
Right. Hi, Vinod. This is Ankita also joining in. Good afternoon to you. Vinod, like you mentioned, the macros certainly are not auguring well as far as Indian markets, Indian equities are concerned, whether it is the rise in the bond yields, crude being on the boil, or, it is the fall in the rupee. None of this augurs well for the Indian equities. But, the kind of correction that we are seeing in the market, we haven't seen this kind of correction in the last 4 years. So now with this fall in the market, do you think now the valuations we are better off in terms of valuations?
Yeah, we are definitely better off. So around 20 times we are at the earnings yield is around 5%, and growth will be better in the second half of this year. And you have to remember that while the rupee, corrected by 2-3%, I guess, in the second half of this year, if you look at the dollar index, it has gained more than 9%. So what it effectively says that the rupee has been relatively better off than other currencies against the dollar. So that's it. And on the other two things, the fiscal deficit we are trending lower. And current account so far is trending around 1%, but there have been some risks to that trade deficit number which was slightly higher, and inflation has been a little higher. But all in all, if you look at the overall twin deficits, the fiscal deficit and the current account deficits, both are currently at least moving favorably. So I think the budget will be focusing on ring fencing this nice trajectory that we are having on the fiscal side. So don't expect any big, stimulus or something like that, which can upset this fiscal deficit consolidation.
All right, but Vinod, if you can help us with the pockets that you're finding good right now in terms of the valuation.
So if you look at the overall market, and we have been saying that in terms of value, two segments are clearly standing out. One is the large financial companies, even on their growth trajectory and the valuation they are. So that is comforting. While we are still forming the bottom of the NPA cycle, we have seen some pickup in NPAs in the unsecured lending for smaller companies, microfinance and all. But I think the larger entities are pretty much forming a bottom of the NPA cycle. There was some pressure on NIMs, but this higher interest rate environment will kind of, I think, counter that. So financials remains one space, I think, where it should be good. And of late, commodity prices have started to pick up. So I think commodities, which are really actually, if you see, have been dragging earnings for last year, may see a comeback next year in terms of their pickup in not only the volumes but realization. So and the valuations are pretty good over there. So from a value perspective, if you were to ask me, these two spaces look the best. You know, but if you were to talk about in general, I think demand will be better off in the domestic cyclicals, which will be driven by this whole focus next year in the budget towards the capex and the development spending, because we are getting into a election light year. There won't be any elections next year, so the focus will be largely on development spending, and so we will see that effect panning out next year.
Right. Vinod, you mentioned two spaces here. You mentioned financials and you mentioned commodities. Vinod, my question is that, the pre-quarter updates that we saw coming in for the banks, they weren't great. And, with the slowdown in the loan growth, the deposit growth, and of course the pressure on the NIMs, do you see that picking up in the second half of this year? What value do you see, in the banking and the financial space? That is one. And secondly, coming to commodities, since, the dollar is at an elevated level, so that puts pressure on the gold prices. So how do you see that moving then?
Yeah, see, on the financials, I think, as I said earlier, on an overall basis, the NPA cycle is still bottoming out for the larger banks, and that's good. But this NIM pressure, I think that concern will recede. I think the way the interest rate cycle we are heading into an area where higher for longer kind of interest rate environment is going to pan out. Earlier, there were expectations that interest rate cut cycle will start very soon, but that doesn't seem to be the case going by how bond yields are moving and how interest rates are currently. So the concern about NIM pressure will be lower, I guess. And as demand picks up, as I said, in the second half, which is yet not seen, the credit growth will also look good. Some of the NBFCs which have given their business updates were not particularly bad. So that's still in the lag data, because that was for the December quarter. I'm talking about the prospects. So I think the growth and the NPA cycle seem to be favorable, and the NIMS pressure concern is abating, I guess, broadly. And as far as gold gold is undergoing a very different kind of a cycle this time around, because it's not just the typical demand that we see. It's more to do with the central banks piling on gold because of their, diversifying their forex portfolio. So that's a very different environment we are in. So gold is moving to that because of that as a significant factor. I think that will continue. So gold should be doing well in this cycle, as long as this phenomena of central banks trying to buy gold as a hedge against dollar that continues. Gold should be in good demand.
All right, so gold is something that you can be watching out as an investor point of view. But Vinod, thank you so much for taking the time out and speaking with us, and also helping us with your take on the markets. But with this, viewers, it's once again time to slip into a very short break. Don't go anywhere. As we come right back, we take the discussion forward, putting the spotlight on the oil and gas space. Stay tuned for more.
If you like this video, then like, share and subscribe to ET Now.